Before we move forward and discuss further about income taxes, I wanted to introduce you to the concept of tax base. I'll revisit the same example which we had done while we calculated the deferred tax liabilities. Here the straight line method of depreciation was used to calculate income statement of the shareholders, and the double declining method was used to calculate the income statement of the tax authorities. Now when we look at this schedule, the beginning balance was the total amount of asset. Depreciation using straight line method was 300 because we had assumed that the useful life was 4 years. So the ending balance came out to be 900, 600, 300 and 0 respectively. These are also called as carrying value. Okay, in this jargon we'll call this as carrying value. And when we were using income tax for tax authorities, we had used double declining method. We got 600, 300, 150 and 150 as depreciation respectively. This will be called as tax base. Okay, so there's a carrying value and this is a tax base. So as you can see, if we talk about just the first year, your ending value is 900 here, but tax base is 600. So what happens is, if in some cases we are just given the carrying value and the tax basis, so we can calculate the deferred taxes just by looking at these carrying values. So say for example, deferred tax liability here would be carrying value minus your tax base multiplied by your tax rate. So if tax rate is 40% here, so here this is equal to 900 minus 600 into 40%. So 900 minus 600 multiplied by 40%. So this is 300 into 40%. So this comes out to be 120. So please note that this is the amount that gets reported on the balance sheet as deferred tax liability. Okay. Now let us look at what happens in year 2. This was year 1 deferred tax liability. Let's look at year 2 deferred tax liability. So what is our carrying value and the tax base? Here the carrying value is 600 and the tax base is 300. So the answer would be 600 minus 300 multiplied by 40%. So this comes out to be 120. So here this is the same deferred tax liability that got reported as in year 1. So there is no change in the deferred tax liability of 120 from year 1 to year 2. Let's look at what happens in year 3. What is the carrying value and what is the tax base? The carrying value is 300 and the tax base is 150 now. So this would be 300 minus 150 multiplied by 40%. So this comes out to be 150 into 40%. This is equal to 60. Now please note that between year 2 and year 3 there is a reduction of deferred tax liability to an extent of 60, and that's why on the balance sheet we see that the deferred tax liability is 60. Now let's look at year 4 and see how much deferred tax liability will it be. Year 4, the carrying value is 0 and the tax base is also 0. So basically we are talking about 0 minus 0 into 40%. So your deferred tax liability is actually 0 at the end of 4 years. So as we have learned earlier that we have taken an income statement approach of calculating the deferred tax liability, you can also calculate deferred tax directly for individual years by subtracting the carrying value with the tax base.